Let's answer the question today. How much money do you need to retire in Singapore with a dividends portfolio? If you are a retiree, a fire seeker, or an investor who prefers a steady cash flow over speculation, then building a dividend portfolio can be a great way to achieve financial freedom. Even though I invest mainly in the US or global markets, I do recognize that at one point in time, I will need to switch to a dividend portfolio to ensure that steady cash flow coming in to me as income so that I can spend it on my daily expenses. And this is to cover cash flow for retirement when you don't have a monthly income coming in. Now, the good news is that dividends from Singapore listed stocks, ETFs, or REITs are all tax-free in Singapore. So there is a massive advantage compared to other taxable income. And if you want another major advantage, that is to join the Telegram group of over 21,000 members of My Honey Money SG Telegram group to join the like-minded people. So how do you go about to build a dividend portfolio for your retirement? The step one is to firstly set your retirement income goal. How much do you need to spend? Assuming at the retirement age, you have already paid up your housing, which is your primary residence, and at age 65, you will start to receive CPF life payouts. A conservative estimate is that you will need $2,500 a month to cover your living expenses. So if you multiply $2,500 by 12 months, that will give you $30,000 of spend per year. Then if your dividend portfolio can give you a 5% return, you will need to take 30,000 divided by 5%, and that gives you a $600,000 dividend portfolio that you should aim for. And once you have this $600,000 dividend portfolio, you can draw down the dividends and use it as your daily expenses in the form of cash flow without even touching your capital base in the dividend portfolio. The next step is to know how to allocate and structure your portfolio, and I'll show it through the Moomoo app. For 20% of the portfolio, I would suggest to invest in a diversified ETF like STI ETF. So I'll say put 20%, this will be your core position. For STI ETF, there are two tickers that you can look at, either ES3 or G3B. This ETF will track the Straits Times Index, giving you exposure to Singapore's top 30 blue chip stocks like DBS, UOB, OCBC, Singtel, Keppel, and etc. The STI ETF offers around a 4% annual dividend yield, and it rebalances automatically, and they pay out dividends twice a year. So that is the 20% core position in the STI ETF. For the remaining 80%, I think you can go about picking your favorite dividend stocks. And here is how I will allocate it. But before that, I want to be really clear that this is just for illustration purpose only. This is not telling you to buy and not financial advice. For individual stock picking, I would really go and select stocks that can have a high yield so that it can boost the dividend income without compromising on the risk. And this may include a 30% allocation to banks like DBS, UOB, or OCBC. That will give you around a 4.5% to 5% dividend yield. So you just pick your favorite. I would also allocate 30% to Singapore-listed REITs. We are talking about tickers like C38U, CapitaLand Integrated Commercial Trust, ME8U, Mapletree Industrial Trust, and O5RU, AIMS APAC REIT. And that will give you an average around 5 to 7% dividend yield. For the remaining 20%, I'll split it across two different sectors. 10% will be on the utilities/infrastructure stocks. These are considered more defensive industries where they will not be affected by market downturn. For example, Sembcorp Industries and ST Engineering. Then the other 10%, I will allocate it to more consumer-focused industries like Singtel, which is a telco, and Sheng Siong, which is a supermarket. So this allocation mix will provide a broad sector exposure and stronger yield than the SCI ETF alone. And one more good news is that in celebration with Singapore's SG 60th birthday, Moomoo SG is offering zero commission trades from 30th July to 7th of September, which is a perfect timing if you want to build your Singapore dividend portfolio. And if you love a little competition, join their Singapore Stocks Trading Challenge. Every 2 weeks, $20,000 in trading coupons are up for grabs if your portfolio returns positive. Beat the STI index and score an extra 1,000 Moomoo points. I also received a lucky draw chance and a $60 cash coupon when I completed 2 DLC buy transactions, so I'm very happy to celebrate SG60. Now moving on to step 3, let's talk about the portfolio allocation example. So remember, we are building a $600,000 dividend portfolio, and 80% of it, which is 480,000, are allocated into high yield dividend stocks. At an average yield of 5.3%, that would generate $25,440 a year. The remaining 20% is in the STI ETF as a core position, and that is $120,000 at a yield of 4% per annum. So that will give you around $4,800 a year. Altogether, if we add up $25,440 with $4,800, we will get $30,240 a year, which is just over $2,500 a month. So that will cover your passive income and your daily expenses. And if we look at the blended dividend yield, that will be 20% multiplied by 4 at 80% multiplied by 5.3, and that gives you a weighted average dividend yield of 5.04% per annum. Note that this is achieved without selling any shares, so you don't have to exit any positions, and the dividends are tax-free in Singapore. Anyway, if you are new to Moomoo, you can get up to $1,120 of welcome rewards, including an exclusive 20 Singapore dollars of NVIDIA stock when you use my exclusive link to sign up and deposit 100 Singapore dollars. There are some funding, trading, and holding requirements to achieve the other $1,100, so make sure you read the full terms and conditions to see which tier are you getting on. But wait, exclusive to my followers only, get a Moomoo Money Box merchandise when you sign up as a new user. This is an additional reward that is stackable on top of any new user welcome rewards from now to 31st of August. You can also register for this promo by clicking the search magnifying glass, then type special deposit and key my code HMSG999 to qualify for the welcome gifts. Terms and conditions apply. So check the link in description to find out more about this Moomoo welcome promotion and get started to invest and trade with Moomoo Singapore. Moving on to step 4, let's talk about risk management. Because so far we only talk about the equities allocation. How about your emergency cash funds? Now, since the portfolio is fully invested, I would suggest you to keep at least 6 to 12% of emergency cash savings, because when you are already in your retirement phase, there is no income coming in and you will need to keep some cash buffer for any kind of emergency situation. And you can store this cash in either high interest savings account, T-bill, SSB, or all the other capital guaranteed assets. And you realize that my portfolio allocation is quite strategic, because we need to diversify across industries to reduce reliance on any single sector or company. But this is not a hands-off passive approach, because you will need to monitor your holdings annually to ensure the dividends are still sustainable, because the dividend yield may change over time and you will need to manage it actively. So ultimately, who is suitable for this kind of dividend portfolio strategy? Number 1, it is really ideal for retirees who no longer have a monthly salary coming in and they need liquidity elsewhere, so they use this portfolio to maximize their income. Number 2, it will be suitable for FIRE individuals who want to maximize their passive cash flow. Number 3, suitable for dividend-focused investors who just want to live on their SGD-based income. And number 4 is suitable for those who are comfortable with a little bit of small fluctuations in their portfolio. But who is it not suitable for? I would say that if you need emergency liquidity within the same portfolio, which means you cannot wait on, then I don't think investing in the dividend portfolio is for you. And the reason is because the cash flow only comes in when the dividends are paid out, when the company has declared it and paid it. So you will need some time to wait for your cash flow to come in. Number 2, it's not really suitable if you prefer capital growth over monthly income gain. And number 3, which is the most important, you are uncomfortable in managing a portfolio of individual stocks, because that requires some high conviction and stock picking skills. So in conclusion, a 600,000 Singapore dollars dividend portfolio comprising of 80% individual stock picks and 20% in the STI ETF will give you around $2,500 of monthly passive income in the form of dividends, which are tax-free. And note that this is all in SGD, so there is no currency risk in terms of foreign exchange fluctuations. You'll gain a balance of control, income, and diversification while keeping things relatively simple. But if you prefer more focus on growing your wealth through capital gains or growth, then I would guess the US and global markets is more preferable for you. which is also what I'm prioritizing right now at my age range where I still have a monthly salary coming in. So I still prioritize capital growth. And if you want to learn how to start investing for beginners, then I can refer you to my very popular video right here.